G'day there everybody, thanks a lot for joining me on this Monday afternoon market recap. This is the chart of the S&P 500 on my screen. Let me just zoom on in so we can drill on into really what's taken place over the past 2 weeks or so. It's very important to get an understanding, really a comprehensive understanding of what to expect in these markets, right? Not just moving forward for this remainder, all right, or the first week in the month of March, but also more so over the next maybe 2 to 3 months as a whole. What we have seen today was a very strong clearing rally. It is what we call a relief rally out of temporarily oversold conditions. Really over the past 1.5 weeks, these markets have endured that of an absolute waterfall sell-off, a bloodbath, an absolute meltdown, whereby we did see the US market indices sell off to around anywhere between roughly 15%, give or take, depending on the market that you're looking at. And it is, I just wanted to say, very natural to see these very strong rallies out of the depths of extremely short-term oversold levels. What you cannot become, however, and this is really the big piece of analysis, or at least the thought I want to leave you with here on that, or as at a Monday afternoon, is that this rally, or at least this time or this particular instance, given of course a little bit of a relief that we have seen in asset prices pushing to the upside, is really not a time to become complacent. All right, again, what we do see during these types of intermediate corrections are these very strong market bounces. But I'd like to just make the point that I don't think a whole lot has really changed from where we were as at Thursday of last week to really what we're seeing in price action as at during Monday's session. Again, this is largely driven by just the very short-term oversold and also now moving into a natural rebalancing out of that territory when it comes to the market momentum and also market direction that we have recently witnessed. Again, And again, not to preface this all too much, but over the weekend, all right, it was roughly a 2-hour class in that pro analysis class. It was 2 parts. The first part went for 1 hour. The second part also went for an additional hour in terms of the big macro picture of the US financial market indices. And then, of course, we moved into the individual trade analysis. And what we're looking at essentially right now, again, without going into added detail, is this relief bounce. Really the entire preface or the entire narrative, the discussion that we had over the weekend was in regard to, of course, this rallying or relief rally that we were expecting, the clearing rally to the upside. We're really starting to see that, right? Volatility is still quite high. Saw the VIX collapse today, which is fantastic. The S&P closing up 136 points. The Dow Jones Industrial Average closing up just shy of 1,300 points. And the NASDAQ, again, closing up just shy of 400 points. So again, in and of itself, today has been a tremendously strong rally. It has been expected. The problem is, however, is that this market at this particular juncture, it's got a lot to overcome before we get anywhere close to overcoming or at least re-establishing new all-time closing highs. And then, of course, a continuation to higher prices further into 2020. What we're most likely going to see, whether or not it comes tomorrow as at Tuesday, or whether or not we see this later in the week, or whether or not it's pushed into maybe next week or the following week, is ultimately this rally that you've begun to see, or at least off from that intra-session reversal on Friday as of last week. And then, of course, the continuation in today's session. This rally here, it is going to fizzle. Right, it is going to fizzle. I've got my red rectangular box on my screen. This is just simply the Fibonacci retracement from this first wave, or what we call the sentence, so to speak, the first sell wave of this intermediate correction. We may actually even overshoot this red rectangular box. It's all the same, really. But what we do have, again, are these magnets of gap open resistance areas, in this particular case on the S&P 500. The same is true for the Dow and the NASDAQ and a few of the other markets that we track as well. But ultimately, it's some later date, and at a higher price, this market is going to stall out. It's going to work in conjunction with, of course, the oscillators moving out of oversold territory on the daily timeframes. Okay, you can already see it taking place on the RSI. The MACD is starting to slope back towards the neutral point. This is all interesting. But again, what you're really going to contend with are these exponential moving averages, which are now going to form as overhead resistance in combination, depending on the market that you're looking at, with some of the overhead simple moving averages as well. So again, this is nothing more at this particular point of a clearing rally, right? It's a relief rally whereby you're going to see equity prices make back a portion of the losses that have been sort of made over the past 1.5 weeks during this waterfall sell-off. Again, nothing out of the blue here. What I don't want you to become, or at least I don't want you to become a statistic in this relief rally whereby you've expected, of course, just to make a V-bottom recovery and to take out this swing high over here. That is not the way this is going to play out. What is most likely going to happen, as we spoke about again in and throughout that weekend class, is that we are going to see this rally. The rally's it's going to stall out either in this red rectangular box, or it's going to happen around this gap retest in alignment with those declining exponential moving averages, which is going to set the stage for a much deeper correction. If there's anything I can say to you at this particular time, as at Monday afternoon, and if you've come this far through this Monday afternoon market recap video just here, is that you can bet your bottom dollar at this particular point that the market itself, in terms of its intermediate correction, it hasn't moved as far as what it is ultimately going to do. What I mean by that is this intra-session low that we priced in on Friday, which is really just the 100% range of what has been the waterfall sell-off so far, is going to be taken out at some point in the future. Whether or not it's in March or whether or not it's in April, time will tell. But this low that we have priced off now, which is the point at which that we're rallying off really through that of today's session on Monday, it is going to be taken out. So again, I understand the opportunity that is presented in the US financial market indices and also the global market indices for that matter. And again, I understand it's a great time to be jumping in and securing discounts at the market based on, of course, the write down in market value across the board, not only in the indices, but also in individual stocks as well. If you wanted to jump on in, and if you've got a longer term horizon, that's fine, that's okay. But you're really looking at something like this playing out. Now, I'm going to leave my screen here for a moment. You can take a print screen of it. You can journal down some notes, but really the sort of the line in the sand that you want to be focusing on, if I had to pick a point, would be roughly 3,300 points on the S&P 500. That's going to be a rough target as to where you would expect this bounce to move to. And then ultimately, you're going to be looking for reversal candlesticks up here. Understanding, again, just based on the general psychology of just sort of inactive market participants, or even just merely sort of pseudo market active participants, is that they're holding a lot of underweight or at least underwater positions that they've accumulated throughout the entirety of 2020. And really their mindset at this particular point is to close out of those trades if they get the opportunity to do so at a price which is somewhat closer than obviously where it was on Thursday or Friday as of last week, to their original purchase price that was somewhere up at these higher values. So again, that's going to act as the overhead supply short term, which again is going to lead to ultimately the capitulation and the complete blowout, which will really exhaust the sell side momentum down here. And this is going to be the true critical area of support, whereby again you want to be leveraging into, or not leveraging into if you don't necessarily want to trade sort of options, but if you really wanted to sort of pinpoint a strategic opportunity to enter into positions, now is not that position, or now is not that time. Okay, it's going to be once we take out the swing low that we priced in on Friday of last week. All right, I went into detail with this, or in regard to this, in respect to this over the weekend in that analysis class. Again, it was 2 hours of analysis. I broke it up into 2 points. I knew I had to speak for longer than what I originally do. Generally, it's somewhere between 60 to 90 minutes. But again, it was just full on in terms of the overall market structure, which is very important. And again, we spoke about this exact thing playing out as well, which we're seeing on Monday. We didn't know really whether or not we'd see continued capitulation and then the rally come Monday or Tuesday. But really, it looks as though, again, as at the close on Monday, that we are staging that clearing rally. And just as I say this, by the way, it really wouldn't surprise me to see this market even potentially down more or less 4% tomorrow. I mean, this is just the volatility of what you're going to have to move through, right, for the next sort of coming weeks, if not coming months as well. So don't think that this is the end of that waterfall or the intermediate correction. My best estimate, and we spoke about this again over the weekend, was that we were somewhere or very close to at least halfway from the top up here down to this reversal candlestick as at Friday's last week. And there was some really sort of valid reasoning as to why that was the case, and also some projections down to some of the more established primary bullish trend lines that we're seeing, especially on the S&P 500. So again, I'm not here to concern anyone or to sort of spruik fear into anyone whatsoever. It's always objective, but don't think for a second, right, that this is going to be the base of the intermediate correction. It's not. This is just simply a clearing rally out of oversold conditions, which is allowing you the opportunity, if you haven't already seen the writing on the wall up here, to reposition yourself net short at these higher prices. Because once we get up into this location, the odds are of a market reversal, at least again on an intermediate time frame, go up exponentially. And again, it just factors into, it really just comprises that of human behavior. And again, psychology of market participants out there who at this particular point are looking for any excuse or any opportunity, and are probably praying to some extent that the market is going to continue up to somewhat higher prices, relatively speaking, so that they can actually liquidate and exit a bunch of positions that, again, they are still underwater on. All right, so I just wanted to say that to you. The same is true for the Dow Jones. You can see this up, again, just shy of 1,300 points. A long day Morobozu candlestick. We closed very strong into the close on Monday. You can see that 100 and 200 is still above price action. So this is going to at least continue to be sort of that of a resistance point on the chart, especially with these exponential moving averages. And when I bring up the oscillators, again, naturally correcting out of oversold territory, albeit marginally at this particular point, but you have to think about the fractals, F for fractal. The reason I say that is because when you flick on out into the weekly, and this is really where the key is of the market analysis, or at least the macro framework and the perimeter of everything, which is sort of set in stone over the next couple of months, is that when you look at the weekly time frame on the Stokes, when you look at the weekly time frame on the MACD as well, not only applicable to the Dow, but the S&P and the NASDAQ, you're going to see a pattern that has that sort of reemerges itself every 1 to 2 years when you get into these intermediate corrections. And this is completely expected as to what we are seeing as at Monday as well. So if you want clarification around that, encourage you to have a look into it. It's really, in my opinion, going to help guide you during this rather tumultuous period whereby you're going to see volatility and pretty much the market behavior pretty much continue to play out with these really erratic and volatile movements and sort of whipsaws that we've seen really Thursday through to Monday of this week. Now, I feel as though I need to preface this video at this particular time with something else. However, at this point right now, it's sort of eluding me. Interestingly enough, I think I've said everything that I do want to say at this particular point. One further thing that I can add to this analysis video is that if you really wanted to digest some of the candlesticks, we started speaking about the bearish reversal candlesticks here, at least the 3-day reversal pattern. This is what we call an evening star up here, right? And it was pretty much just before we saw the exhaustion up here and the false breakout on this candlestick, which again we spoke about publicly here on the YouTube channel. Now, if you pay very close attention, you've got the same pattern. However, this is on the bullish side as well. I'm not placing as much weight of the evidence or the actual analysis into this reversal pattern. It is technically showing up in the right location, as it is sort of, establishing itself off support. But this is, again, some form of a knee-jerk reaction, which is establishing not that of an evening star reversal pattern, but it is more so that of a morning star, whereby the actual the star itself is on the downside, which is creating, of course, the two Morobosu candlesticks at the top. So somewhat of an inverse pattern to what we were referencing over here earlier in the period of February. Again, this is a short term, in this particular instance, bullish pattern, right? But you don't want to just simply go out and buy the open as at Tuesday, expecting the market to move up in a linear fashion like this. Again, you're going to see probably continued volatility, but overall expect the market to continue to push on up. This is what we call the minor level, working in conjunction with the intermediate level, which is working in conjunction with the primary macro bullish trend still. So again, it's a bit of you're using and applying different fractals to the market at this particular point, but I'm hoping at this stage right now, you're starting to see what we're looking for. And we've been pretty much spot on the money for quite some time when it comes to tracking the performance of the US market indices and what to expect coming from the moving forward. The only thing I'm going to say further until I say farewell is that this is not going to be the low of the market. Okay, so take that as it is, do with it as you please. But this is not going to be the low that maybe people are calling for at the moment. This is really just a little bit of a speed bump. This is a breather. This is the clearing rally, the relief rally, which is ultimately going to get sold up here. And then really what you want to do and think about is that when you see the capitulation, the absolute blowout below this low over here, and again, this could take a number of weeks to set up, right? Mind you, it could take quite some time to actually establish this. But once you get below this swing low over here, you're going to see short-term capitulation in the marketplace, whereby a lot of people are truly going to panic, and then that's going to be the longer-term opportunity to buy this market. But if you want to just start moving in at the moment, I don't blame you for doing so. You are getting the market at a discount to what it was trading at, obviously earlier on in the calendar year of 2020. So I hope that helps everyone. Again, I'd encourage you to look into that analysis class. It's recorded, it's up on the website. However, again, I'll be back with you during the week for some more market updates. It's James signing off on behalf of Pivot Point Trading. All the best, everyone. Farewell.